Welcome everyone, I'm Kevin Davey and welcome to 3 ways to improve your trading performance today. So if you follow the things that I'm going to give you, I can almost guarantee you that your algos are going to be better than they were, because these are 3 pretty important points. 3 proven ways to improve your trading performance. Okay, so let's get started with that. So first, the disclaimer, US government requires it. If you've never read it before, take some time to read it because there's a lot of good stuff in there. Don't trade with money you can't afford to lose. Past performance is not indicative of future results. Hypothetical results are just that, they're hypothetical. And all trading systems are built with the benefit of hindsight, and that does introduce a bias. If you recognize those things when you're building a trading strategy, and you account for them as much as you can, you're going to be a lot better off. Trust me on that. Okay, so I'm going to ask a question. Just type a Y in the chat box. Have you ever experienced this, where you build a back test and up until about trade 100, 650 or so, that's what your back test looks like. That's what I call the development phase. That's when you're optimizing, you're changing rules, you're doing whatever. Probably most of us have built back tests like that. But then they go live, and that's in the light blue, and it does this sort of thing, where what was a great looking back test turns out to be losing to break even live performance. I'm guessing almost everybody who's listening to this has experienced that. And a lot of times it comes down to having an overfit back test, doing something wrong with the back test. You've optimized too much. You've put in too many rules. You've tested over and over again, and you've gotten this great fit. And what usually ends up happening, it does poorly in real time. That's probably the biggest problem I see with algo traders and people doing it. What they get in real time just doesn't look like the back test. So we're going to hit a bunch of things today that are going to address that and hopefully turn that around for you. Because for most traders, this is elusive. So don't feel bad. Don't feel bad if you've built systems and this is what happened. They could be algo systems. Maybe it's your discretionary trading where you did some manual back testing, whatever. This is really common. So, if you feel, oh man, I'm a failure as a trader because I did this. No, don't feel bad about it. Getting good real-time performance is really hard. It's a lot harder than creating a nice back test, I'll tell you that much. Creating the nice back test is pretty easy, but getting it to perform decently in live trading in real time, that's the tough part. Okay, so I just want to make sure everybody realizes that, hey, it's not like you're making some fundamental flaws. You're probably doing what a lot of other people are doing. I certainly have had systems like this. I still once in a while get systems like this. So don't feel bad about it. Now, I teach a workshop that helps people build algo strategies, and they've actually created 489 strategies that actually worked in real time. What we do is we have a club where I monitor the strategies for 6 months of live performance. And we've had 489 strategies so far that have had successful live performance. And that's after joining my workshop. So these are people that learned my techniques and then applied it and actually created good strategies. And this is part of my Strategy Factory school, which has won quite a few awards. And for the last 3 years, it's either been 3rd place or 2nd place in technical analysis of stocks and commodities magazine. So the only people who beat me out were I think Thinkorswim and TradeStation, which are big companies. It's just me here. So that tells you something about what I'm teaching. So if you look at what my students do, you can learn a lot from what they've done. And that's what this whole webinar is about, because I'm going to show you some of the things that I have seen them do that have helped them build successful strategies. So if they do it, you can do it, and you can build some good strategies. Okay, so there's 3 secrets that, you know, either people don't know or people kind of ignore or dismiss, and they, oh, that's not important. So I'm going to go over these, and I have little nicknames for them. The first one is called Inopt. The second one is called Good But, and the third one is called Baby It. Okay, so I'm going to talk about each one of these secrets. So get ready to take some notes on each one of these, because I can pretty much guarantee you, if you adhere to these secrets and incorporate them in what you're doing when you're building a strategy, you're going to build better strategies. So let's talk about the first one. That's Inopt. Okay. What it stands for is intelligent optimization. So right there, that should tip you off on how I view optimization. 1, I don't say no optimization, right? So I'm saying you can do it. You just have to be intelligent about it. And I think experienced traders really understand this, and they try to minimize it because they realize you can't optimize your way to success. Less experienced traders think that's the route to go. And I see it all the time on trading forums. People say, hey, I want to run a back test, but it says with the optimization, it's going to take 2 days. Should I buy a new computer? That's their answer. And usually when I answer, and I've stopped answering a lot of them because I was just getting grief. What I would answer is, you know, maybe the answer isn't a faster computer. Maybe it's changing how you're optimizing. And these people do not want to hear it, because guess what? They think you can optimize your way to success. Oh, if I only do a couple more back tests and add a couple more variables and add a bigger range and optimize a little more finely, I can get the holy grail strategies. That's what inexperienced traders think, and losing traders think that too. But people who are experienced at this and who do good at it, they realize you can't optimize your way to trading to success, real-time success. And the reason why, one big reason, is price data is noisy. Here's just an example. This is a while back, but this is the ES 1-minute chart, and you can see it bouncing around a couple points here or there. And, you know, you try to draw a signal through that. There's a lot of noise. What's noise? What's real? I don't know. This all could be noise, especially when you start looking at higher time frames. You know, a couple points here or there could be noise. The problem is when you go to optimize, the optimizer doesn't distinguish noise from real signals. It just says, oh, hey, this is the price. And it assumes really no noise. So that really leads you down a road of finding a perfect curve fit to this, whether it's real or it's noise. And fitting noise is never going to work, okay? Because what you end up doing is you get a perfect curve. You know, let's say you were trying to do like a moving average or something. I'm just going to draw the squiggles like this. So maybe it does this thing, and you get a perfect equation for that. And you say, wow, you know, I've really captured the market. Well, no, you haven't, if it's noise. If this is all noise, you know, you might as well had something like this. It'd be just as good. So realize that price data is noisy. And that's when optimization, it tries to fit to the noise, and it just causes causes a lot of problems. And there's a good example. This is some kind of moving average where I just kind of fit it to it. And it looks like it's a good fit, but hey, if you're fitting to noise, you got to watch out. So the trick with optimization and the way to do it intelligently is you got to have balance, right? So think of it as a scale. On one side, you have your inputs. You know, do you have 2 inputs? Do you have 30 inputs? How many rules do you have? You know, do you have buy and sell rules for every kind of market regime? And maybe every month you change the rules. And then iterations. How many optimization runs are you going to do? You know, are you going to run a moving average from 2 to 200 in steps of 1? And you got to balance that with the future performance. And my experience, and the experience of most people who do optimization, is the more you focus on the left side, meaning more inputs, more rules, more iterations, the worse your future performance becomes. So it gets out of balance. So what you want to do is you want to keep this in balance where you don't use too many rules, and then your future performance is better. And that's the trick. It's, you know, and I can say it's pretty hard to follow. So I'm going to give you some specifics on this to help you out, because more is not better. Okay, so you might say, well, hey, okay, you're going to give us specifics, but how'd you get them? So I've gone through and I've reviewed well over 2,000 strategies. These are from students who've taken my course and my own strategies. And I kind of analyzed them for what do the good ones have in common? What do the bad ones have in common? Okay. And here's what I found. Real-time success. You have a much better chance of real-time success when you have strategies with the following. First, less than 4 optimized inputs. So let's say you're doing a moving average with a stop loss and a profit target. Just make sure you're not optimizing more than 4 things. Okay, and I've seen people optimize 50 different inputs. It's crazy. Stick with a small amount. You can think of it as having 2 to cover your entries and 2 to cover your exits. It's hard to curve fit. It's hard to overfit when you only have a few inputs that you're optimizing. Also, I've found that the best strategies are symmetrical. They can go long or short just as easy. The one exception to this, maybe 2 exceptions, would be stock index futures, which have a long bias because stocks go up, and possibly also interest rates, because, you know, the last, 15 years, interest rates were going down, and that means most of the interest rate futures, the 30-year, the 10-year, they were going up because they go up inversely to interest rates. Those probably go to the long side, although this year it's definitely been the opposite, where it's better to have been short. But currencies, metals, energies, a lot of times it's just good to be symmetrical, long and short. And you might say, well, wait, you know, short, the market falls faster than it rises. And yes, that could absolutely be true. But realize if you have separate rules, long and short, you're probably going to have more inputs that you optimize. So part of doing this symmetrical type strategies is you limit the amount of inputs. And then finally, the other big thing is the number of iterations you run when you do optimize. And what I've found is the best performing strategies, or the strategies that are most likely to perform well into the future, less than 1,000 iterations, and actually less than 100 is even better. if you can do it. That means, though, you're not going to get a perfectly smooth equity curve. And a lot of people don't like that. But trust me, the equity curve, the back-tested equity curve, it matters to an extent, but that's not the goal. A lot of people think that's the goal. The goal is real-time successful performance, right? So if you do these three things, you'll probably have a worse looking back test, but you'll probably have better real-time performance. And again, I didn't imagine these out of whole cloth and, just came up with them. This is based on analysis of over 2,000 strategies. The best real-time performing strategies had these characteristics. So keep that in mind. Okay. The key with intelligent optimization is less is better. And hopefully that might be you. It kind of blows people's mind because a lot of people, especially technical people, engineers, scientists who go into trading, think optimization, more optimization is actually better, but it's not. And trust me, I have an engineering background, so I used to fall for this too. Don't fall for it. Okay, so that's secret number one. Secret number two is what I call good, but. And what I mean by that is good, but not too good. So it's sort of related to the previous one, but the easiest way to explain it is a lot of times when you start out developing a strategy, you'll end up with an equity curve that looks like the one on the left. That's your starting point. And you're like, oh, it makes money, but ooh, it's got some drawdowns. It's not consistent. I'm going to tweak it. I'm going to add rules. I'm going to re-optimize. I'm going to do all sorts of things. And eventually you might end up with the curve on the right. Hey, everybody would look at that and say, ooh, that's a nice looking equity curve, right? And at first glance, you would think it was, especially if you didn't know what went into it. But almost any strategy can be made with enough changes, can be made to look great. And that's the problem. That's the dilemma, where you want to make the back test look good, but not too good. Okay. So one way to measure this, that again, I went through thousands of strategies, is the return to drawdown ratio, which I calculate with a Monte Carlo simulation. You can get the spreadsheet for free off my website. But what I saw was if the return to drawdown ratio, so what that measures, first, does me back up. What that measures is how much risk basically you have for a certain return. So let's say for every $2 of return, you have $1 of drawdown, then your ratio would be 2. And that's pretty good. So you want to have it something good, but if it's too good, it kind of implies or indicates you could be overfit. You could have back tested too much. So here's what the data shows. Below a certain threshold value, which we'll call X, right here, you get about 28% of your strategies to pass. And if it's above another value, a higher value, we'll call it Y, you get about 35% of strategies to pass. But if you're in between X and Y, your chances of success go way up. So there's this sweet spot where the strategy is good. I would say this is bad right here, BAD. This is too good. I'll just say TG. So you don't want to be bad. You don't want to be too good. You want to be just good enough. And then you're in that sweet spot where those strategies tend to work the best in real time. So You might say, well, what's X and Y? Tell me what X and Y is. Okay. Get to that in a second. So somebody once said, hey, this is like Goldilocks and the Three Bears, you know, where this strategy is too cold, you know, this porridge is too cold, this strategy is too hot, but this strategy is just right. And that's where you want to be, right in that middle. Okay. So again, I use my Monte Carlo spreadsheet to calculate it. And here I call them X1 and X2, but this is like X and Y. I've determined values to use. I share this with my strategy factory students. I'm going to give you a way that you can do it for yourself. You know, obviously, if you don't think about taking my class, but obviously people who take my class, they get those numbers and then they know. Okay. So if you want to do it yourself, hey, more power to you. Download my spreadsheet. It's on my website in the resource section. And then you have to analyze a bunch of your strategies with real-time performance. And if you analyze them, you'll be able to figure out, hey, ones that don't work well in real time, what's their Monte Carlo return to drawdown? And then ones that do pass, what are those? And what you'll probably find are a low and high value. And if you're in between those, you're more likely to pass your strategies. Now, the tough part about this for most people is you really need probably 50 strategies to analyze. You can't analyze 2. That's not going to give you enough data. The more, the better. Like I said, when I looked at this, I looked at thousands of strategies from myself and from students. So I feel pretty comfortable with those results. And the other thing too to consider is maybe, hey, I don't want to do return to drawdown ratio. I want to do some other metric. You know, you could do it, but just remember, anything, profit factor, percent win trades, whatever you use, there's probably a point where if it's too good, it's going to cause you to have bad performance because it means you've over optimized. Okay, so you want a strategy that's good, but not too good. So, you know, return to drawdown, the way my spreadsheet works, you can go and look at it. It will consider all the trades, and the calculation actually uses what's considered a median maximum drawdown. So since it runs random simulations, let's say it runs 100 cases, you have 100 values of the max drawdown, it takes the one right in the middle, the 50% one, and that's what it uses for its calculation. Okay, and of course, if you don't want to do this, you could attend my workshop and get the benefit of all these previous students and what they've done and what's worked for them, what hasn't. And speaking of that, hey, okay, this is pretty highly ranked workshop. As I said, it's won awards. It's gotten 5-star awards on a bunch of websites. Trustpilot, it's gotten great reviews. You know, I teach what I actually trade. I think that makes it kind of authentic. And a lot of people who take the class think so too. So it's something to consider. It's not for everybody. I'll explain a little bit later. It's a commitment. It's a time commitment, and obviously it's a money commitment. Not everybody can do it. But for those of you who are really dedicated with algo trading and want to take that next step, this is really something to consider. Okay. And by the way, this approach, I've actually taught 7 traders who used part or all of what I've taught and gone on to win some trading contests. So that says something too. Okay, so secret number 1, in-opt. That's intelligent optimization. Secret number 2 was good, but not too good. And the third one is baby it. Okay, and you might be like, what? What does that mean? Well, here's what most people do when they build a strategy. They build it, you know, they get their rules, they back test and optimize it, and then immediately go start trading it live. And then they lose money. And of course, once they lose money, they go on and say, oh, I just need a different strategy. And they go again and again and again. What we do, meaning myself and people who take my class, we build the strategy, we back test, but then we have this important step. We wait for 6 to 9 months, and we only trade live. We only go to live trading with this strategy if that performance for the 6 to 8 months was good. And then, of course, if it was, then you have confidence and you're like, oh, wow, this actually works. And you build more and you go back. So again, it's a loop. You keep building them, but you get this feedback that, hey, I'm building strategies good because they're working in real time. I cannot overemphasize how important that is. I used to do what's on the left. Probably 90% of you do that. When you jump to what's on the right and you wait with your strategies, it opens up a whole new avenue for you, a whole set of new doors, because you're only going to trade the ones that have worked in real time. And does that guarantee they're going to keep working? No, not at all. But I'd much rather trade ones where I know there was some real-time performance, where I wasn't back testing my way to success. It's hard to mess with real-time performance when you do it correctly. That's what this is. I call it incubation. That's why I call it baby it, because you think of baby chicks, under a heat lamp, they do incubation. That's what you're doing with strategies. You build them, then you set them aside for a while and let them grow. And it's not necessarily the same as running in a simulated account. It depends on the simulator to an extent, because a lot of simulators are not accurate at all. I don't run on sim when I do this. I never do. I just open up my strategy back test every month and see how I've done. And you might say, well, wait, your back test isn't the same as real trading. No, it's not. But if you build your strategy correctly, if you account for slippage and commission correctly, that strategy performance report mimics real-time trading pretty well. So it's a pretty good indicator. And that's what we use when we do the Strategy Factory Club. I actually open these strategies once a month and record what they've done, and works out pretty well. Okay, so why does this work? Well, here's a simple metric, or a simple analysis I've done. So I've calculated what I call the efficiency. Okay, so let's say your back test, you averaged $1,000 per month. Okay, or just an average. And then let's say you run it for 6 months of real time, and hey, it was $1,000 per month over those 6 months. That would be an efficiency of 1, right? It's $1,000 real time per month divided by 1,000 back test. The flip side is, what if it lost money during those 6 months? Well, then you'd be on the red side. And there's a certain level of efficiency that you want to see during that 6-month period. And this chart kind of shows you why, because the ones that perform bad aren't going to pass. The ones that are good will pass. So it helps you eliminate many of the what I call dogs, strategies that looked good in back test but fall apart in real time. Because you're going to have them almost no matter what you do, no matter how you develop systems. Okay, and you might say, well, why? Noise is everywhere, luck is everywhere. You could run a back test and just happen to get lucky. But what happens is in real time, usually luck fades away. So this turns out to be a great measurement, this efficiency of comparing the real-time performance to the back test. And it's not just me saying this. I've asked my students over and over again, a couple times at least, and one time it was 88%, the other time it was 90%. I asked them, has this step, has doing this incubation saved you money or cost you money? And 88 to 90% of them said it has saved them money. Why? Well, because they've avoided trading some of these dogs. The flip side to it, the downside to it is, what if you have a really good strategy and it's making money? Now you have to wait 6 months or 9 months and you watch those profits that you aren't getting because you're not trading it for real. That does happen. That's the price you pay for it. But overall, you're going to find you avoid bad strategies, and that's going to make up for any good strategies that you aren't trading during that period. So again, 88 to 90% of people said, hey, this saves them money. Okay, so my approach is I calculate the average monthly profit, just like my example. Then I calculate the real-time performance. And then I say B divided by A. If it's greater than a certain value, then go live with real money. And I give that to anybody taking my class. Now you could do it. Again, what you'd want to do is take a whole bunch of your strategies and calculate A and B, and you would determine that double Y from your own strategies. And it might be different threshold than what I use, but it would be based on your own strategies, which is pretty nice. So that's what you want to do if you want to use this. You want to compare your backtest performance, preferably walk forward or out of sample, and compare that with your real-time performance. Take the ratio of the two and see where that falls. Okay, so that's how you can do it. Again, if you don't want to do that for 50 or 100 strategies, the alternative is to follow what I do. Okay, so those are the 3 proven secrets. Each one of these has data behind it. I mean, I'm not making this up. I'm not saying, hey, this is good just because it sounds good. These things actually work. And if you incorporate all of them, your trading will get better. I can almost guarantee it if you really follow these things. If you keep the number of iterations low, keep the number of inputs low, you optimize intelligently. That's the first one. And then if you look at return to drawdown and you have a certain threshold, but you keep it below an upper limit, you don't get that perfect looking equity curve, because the perfect looking equity curves are what I would call unicorns. They, one in a bazillion exist, and chances are when you find them, they're not going to work in real time anyways. So that's the second secret. And then the third secret is, when you're done developing a strategy, don't start trading it right away. Let it sit for a while and then come back to it and make sure it's performed in real time. And, part of that, I shouldn't have to say it, but don't go making changes to the strategy after you develop it. You develop it, that's it, you're done. And then you're going to see how it works in real time. And that's called incubation. And the secret is baby it. So those are the 3 proven secrets. And like I said, you use these, you're going to be a lot better off with your trading. Those values, so I gave you some values to use for that first secret. For the second and third one, if you do it yourself, they're going to be different than what I use, because you're going to do things a little bit differently. But you should take 50 to 100 strategies that you have where you have some real-time performance. And if you don't have that many strategies, well, you got to do some work and get them. And those values are going to depend on how you do all this, okay? And again, for people who follow what I do via my workshop, I share those values so they don't have to figure them out. They can just say, oh, okay, well, if I follow this process, this step-by-step process to build strategies, then here's the values I use. But you can certainly do it on your own, just takes a little more work. Okay, so again, my solution with all this is the Strategy Factory. This is where you can learn these secrets from me. I give you one-on-one support via email. I don't send it off to a third world type thing. And my course includes easy language programming for those of you not familiar with TradeStation. It has a private club, a private forum. The club, you can actually share strategies with other students and their strategies that work in real time. And I give you strategies you can trade and a whole bunch more. So if you're interested, go to my website. You'll see plenty of info on it. And there's the link for that. So more information, that's where you go. Here's just some actual strategies that some students have made. You can see they're good, they're not great, they have drawdowns. But again, you've got to change your mindset. If you think, hey, I got to have a perfect looking equity curve, because you're going to be disappointed with this, okay? You don't want a perfect looking equity curve. All right, so that wraps up the 3 secrets. I want to thank you for joining me, and let me know how it goes. If you use these concepts, let me know if it's improved your trading. Hopefully it will.